Hey everyone, welcome back to Corporate Decoder, the place where we unpack financial statements as if they were secrets of the universe. And let me tell you this, Citrine Global Report has some interesting twists and turns. It seems like they are really trying to get their footing after a shaky period, and the numbers tell a big part of that story. So let's jump right into the heart of it, the financials for the quarter ending June 30, 2024. Looking at the balance sheet, we see that as of June 30, 2024, Citrine Global had total assets of about $1.6 million. But what's really eye-opening is their cash position, a mere $3,000, which is a pretty stark decrease from $7,000 at the end of the previous year. This tells you they are really tight on immediate funds. On the other side of the coin, their total liabilities stood at around $54 million. Now that's a lot more than their assets, which means they have a negative net worth of about $3.8 million. Put simply, they owe more than they own. This is often called the deficit in shareholder equity, and it suggests the company is in a tough financial spot for sure. Now let's peek at their income statement. For the 3 months ending June 30, 2024, their net loss was $1.25 million. This is quite a jump from the $676,000 net loss in the same period last year. It definitely looks like things got tougher for them during this quarter financially. The year-over-year comparison for the 6-month period ending June 30th, 2024 shows an even more significant increase in losses. Net loss more than doubled from $1.5 million in 2023 to a staggering $1.5 million in 2024. This widening gap in losses is a major red flag for investors, signaling that their business model is not yet profitable and possibly facing increasing costs. Their cash flow statement reveals that for the first 6 months of 2024, they used $30,000 in operating activities. This is better than the $97,000 used in the same period of 2023, but considering their extremely low cash balance, every dollar spent is critical. Now let's talk about the related parties. They have convertible notes with related parties amounting to $2.26 million. This is a significant chunk of their debt being owed to entities connected to the company. It raises questions about who these parties are and the terms of these loans, especially in a company with such limited cash. Interestingly, the stock to be issued line item shows a drastic drop from $1.45 million at the end of 2023 to just $51,000 at the end of the second quarter of 2024. This could mean that some of these planned issuances for services or other obligations have been settled, or perhaps are no longer on the books, which is an interesting movement in their capital structure. They also had events after the reporting period that are important. One such event was a promissory note issued in February 2024 with a significant original issue discount, meaning the company received less than the face value of the loan. Then there was an agreement with X Group Fund of Funds Limited Partnership to purchase securities for $250,000 with payments due in August and September 2024. However, it seems the X Group didn't follow through on the payments, and that agreement lapsed, meaning potential funding didn't materialize. A significant development involves consulting agreements with Dear Light Limited starting in September 2024. These agreements carry a monthly retainer of $11,000, but all payments are deferred until certain conditions are met, like listing on a stock exchange or successful fundraising. This shows they are securing services, but the payment is contingent on future success, which is a common strategy for cash-strapped companies. Then in January 2025, Dear Light Limited also signed an investment agreement committing to invest $137,000 for shares and warrants, adding another layer to these related party dealings. A notable positive event was the notification in January 2025 that their subsidiary Canovation Center Israel Limited received a government grant of $3.4 million. This grant is for establishing a SkyTech Innovation and Production Center and is a significant boost from the Israeli government supporting the defense sector. This could be a major turning point for their operational capabilities. As for reorganizations, the company's Israeli subsidiary, formerly Canovation Center Israel Limited, changed its name to SkyTech Orion Limited in May 2025. This name change likely reflects a shift in strategic focus, possibly towards the defense and drone solutions mentioned in relation to the government grant. Further aligning with this strategy, Citrine Global Corp itself changed its name to SkyTech Orion Global Corp in June 2025. This rebranding signals a clear pivot towards UAV and drone solutions, which will be interesting to watch. Now, digging into the operations management highlights the impact of the war in Israel starting October 2023. They mention this has caused widespread uncertainty, disruption, and affected their operations, impacting their execution of planned business initiatives. This is a crucial piece of context for understanding their financial performance. They hold various equity interests, including a 100% stake in CTGL Citrine Global Israel Limited, a 60% stake in what is now SkyTech Orion Limited, and a 19% stake in IBOT Israel Botanicals Limited. They also own industrial land in Yerutam, Israel. An important detail is the option to increase their stake in EBU Israel Botanicals Limited up to 51% by June 30, 2024, which they ultimately decided not to exercise due to the economic uncertainty. This means they stand by their current 19% holding. On the income side, they show research and development expenses as zero for both the 3 and 6 month periods ending June 30, 2024. This is a bit surprising for a company in the innovation space, perhaps suggesting they are relying on external partners or have paused R&D activities. Marketing, general and administrative expenses were $264,000 for the 3 months ending June 30, 2024, compared to $535,000 in the same period of 23/4 cash burn passion of $25,000 in the same period of 20. They attribute this decrease primarily to a reduction in non-cash share-based compensation expenses, which is good news for their cash burn. Financing expenses paints a different picture though. For the 3 months ending June 30, 2024, these expenses were $54,000 compared to what they call financing income of $113,000 in the prior year period. They explain this shift is due to finance expenses related to convertible loans and notably a 930 OT options, which really swings the numbers significantly. And finally, their overall financial condition shows a working capital deficiency of nearly $3 million as of June 30, 2024. This means their current liabilities far exceed their current assets, and paired with only $3,000 in cash, that's a serious liquidity challenge. So what's the verdict here? Citrine Global, or should we say SkyTech Orion Global Corp, is clearly in a transitional phase. They are making strategic pivots, particularly towards defense and drone solutions, a big move signaled by their name changes. The government grant is a lifeline and a potential game changer if utilized effectively. However, the financial realities are quite grim. They have a substantial debt with related parties, are burning through cash with a minimal cash reserve, and are operating at a significant loss. The reduction in G&A spending on share-based compensation is a positive step for cash conservation, but the increasing net loss and the substantial financing expenses, including fair value adjustments, are major concerns. Anticritic file positions is a positive step for cash conservation, but the increasing net loss and the substantial financing expenses, including fair value adjustments, are major concerns. Their reliance on future events like stock exchange listings or successful fundraising to meet payment obligations in consulting agreements highlights the high-risk nature of investing in this company right now. While the government grant and strategic refocus offer a glimmer of hope, the path to profitability and financial stability looks very challenging based on these numbers. They need to convert this grant opportunity into tangible revenue and operational strength very quickly. Alright, that's our deep dive into Citrine Global's latest report. What do you think about their pivot and their financial health? Will the rebranding and government support be enough to turn things around for them? Let us know your thoughts in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community linked in the description for even more discussions. Thanks for watching, and we'll see you in the next one.